Good afternoon, everyone. Welcome to the ECMCEIF and Avalanche BC All Learning Series. This is the third session that we're doing this year. It's a unique opportunity for edtech and workforce innovators to gain valuable insights and strategies from industry experts. We had 4 different folks come and speak to the founders, and we've got many more lined up. We're really excited to be doing this in collaboration with one of our closest friends. I've known her for a long time. She's been a friend and regular co-investor for years at this point. But also ECMCEIF is an LP in the fund, and we're very glad to be supporting her. Avalanche BC invests at the pre-seed stage in companies changing how people learn, earn, and own. If you're building a solution in that space, definitely reach out to Caitlin at Avalanche. Highly recommend her as an investor on your capital. We represent the ECMC Group's Education Impact Fund, the $250 million evergreen fund focused on improving post-secondary and career success outcomes for underserved populations in the United States. I know that sounds like a lot, and we certainly feel the weight and the burden of wanting to make generational change for the upcoming population, but we really believe that we're making an impact here, and we've had success backing lots of companies in that space. We've got 26 portfolio companies. Reese is the founder of Acadium, which is one of our portfolio companies, and we're very happy to be supporting them. So that's us. Today's session is all about financial modeling and how do you actually get to a model that is valuable not only for you in how you plan your operations, but also helpful for you to be able to present to investors so that they can understand what assumptions you're making and what trajectory you're on. So with that, I'm going to turn the stage over to Eric and Chuxin, who will lead you through the session. If you've got any questions, just put your questions in the chat or in the Q&A box. We've also got a pre-read or a sort of companion read that we'll share in the chat so you can follow along. Eric, over to you.
Thanks, Athin, and thanks to everybody for joining us for our next episode of the Fall Learning Series. Today, we've got an exciting topic from projections to profits, financial modeling essentials for startups, and how to build a model investors will love. As you can tell, we'll be delving into one of our favorite topics here at the ECMC Education Impact Fund, a topic that can be challenging to navigate for founders and for investors, and particularly for people that don't have a background in accounting and finance. For that reason, we decided to dedicate an entire session to the topic and plan over the next hour to share some tips and tricks we've picked up over the years on financial modeling, highlighting some do's and don'ts, investor expectations, and hopefully making this presentation actionable for you guys on the call, for founders who are thinking about creating a model or perhaps already have a model and want to revisit it. Our agenda for today is going to spend about 15 minutes buzzing through slides that provide a high-level overview of the why and the what of financial modeling, which should hopefully set us up for a stronger foundation for the second half of the discussion, which Chuxin will lead more around the how. So actually rolling up our sleeves, she's prepared an example model for a fictional company, and we're going to walk through step-by-step on how to build that. This entire discussion is more oriented towards those who are newer to financial modeling. If you're an experienced founder, some of what we cover today may be stuff that you already know. The first question is, why model? Why even spend the time to create a model? And there's 3 main reasons that we have listed here. There's countless others, depending on who you speak with. But the top 3, especially when you're in the early stages of your business, the first one is a forcing mechanism for you to carefully consider what goals and milestones you have and where you want your business to be in 2, 3, 4 years from now. So it can be as easy as, getting out a piece of paper and writing down your thinking, but it sharpens your thinking and makes you carefully consider those business goals. You can't hit a target that you can't see. This is the first step in the process of building out a roadmap that really allows you to put the different challenges into perspective and starts to clarify decision-making. The second reason is it starts to help you articulate your thesis. As founders, you start with pitching the vision. This is another way of translating that vision into numbers, as probably many people on this call plan to do at some point, start to have those investor conversations. This is an important tool in your toolkit that will help you facilitate some of those conversations with external stakeholders, namely investors. And then the third reason here is, and this becomes probably more important as you mature as a business, but it starts to help guide your actual decision making. And any good model should help facilitate that. It's really about providing a data-driven roadmap of where the company should go. It helps you start to manage things like your cash runway, measure things like for your key performance indicators to ensure that you're on track, all in a way that you can share with people. So if that was the why, what is the, and I really like this quote from Guy Kawasaki. I think it does a good job of summarizing the what of a financial model. The one word that I really like here is story. In my experience, whenever you start talking financial models, it becomes very easy to get lost in the minutia. There's a lot of numbers, there's a lot of tabs, things start to get very confusing, but it's important not to lose sight of the overall story, right? A financial model at the end of the day is telling the story of your business using numbers. Said differently, is the equation of your business, and it's something that should be a tool for telling your story, not something that stands alone. Speaking of external stakeholders, our favorite external stakeholders are investors. A financial model is something to translate between yourself and the investors. And I like the term lingua franca. The dictionary describes it as common language. You can think of this as a way to take your story and translate it in a format that makes sense to investors. And what are investors looking for? They're looking for it to make sense, first and foremost. They're looking that you have a plan, that you have a roadmap, that you have clearly identifiable goals that you plan to achieve, and a roadmap in which to achieve those. So that's the credibility piece. As you continue to mature as a business, by Series A, the expectation becomes that you absolutely have one of these in place and that you're using it, you're updating it on a frequent basis and using it as a way to guide your next 6 to 12 months. I like this quote. And this goes back to illustrating the point as a earlier stage company. Really, the model is a way to illustrate your vision, to tell a story using numbers. As you continue to mature as a business, it becomes more about actually guiding your management decisions. As you gain altitude here, as you mature as a business, the more tools and instrumentation that becomes required. So I know we just spun through a lot there, but as a quick recap, and you'll hear me say this a few times through today's discussion, most common pitfalls align with the things that investors are looking for in every model. It needs to tell a story and align with the story that you heard on previous calls with the founder. So it needs to align with the story you heard on the first call. The model needs to make sense. Is it accurately portraying the key business drivers of the business? If it's a software business, does it have broken out key business drivers around renewal rates or retention? It has to be actionable. It has to show a roadmap that is a plan on how you would plan to achieve your goals and what are those goals 6, 12, 24 months out. Before we get into, first I want to just pause there to see if there's any questions before we actually get into the modeling part of the discussion.
Do folks have any questions? You want to use the chat box, type in. I think the one question that comes to mind for me is just how often should you be updating a model?
Yeah, so that's a good question. I think that probably depends on what stage you're at. So as the model becomes more of your management toolkit, it should be updated more regularly, probably monthly, at least monthly with actuals. The earlier you are as a business, it's more important that you're updating it before key conversations. So you absolutely want to have a model that's updated, that makes sense, that's clean of errors before you go into these larger conversations.
I think it's really hard to overstate the importance of reconciling your model to what actually happens month over month. This will help you drill down on your assumptions and face the reality of the long-term health of your business. So practically, a tip I'm happy to share is like, just make sure you keep a copy of the original model for reference. After you reconcile your books every month, you can open your financial models and do a couple of things. One, tweak the assumptions to get the current month close to actual. So put in the actual number for the month. Then you can plug in those numbers in your monthly statement to replace the formula from your assumptions. For the future, those assumptions will still remain the same and you can tweak those assumptions as well. I actually have one of those. This question gonna touch on this after I go through the model, which may make a bit more sense, but happy to preview that as well.
I think that's a good reminder of not using your model for revisionist history. You should update it on a monthly basis, yes, but you should also have the original model saved separately so that you know what you were initially projecting and what your budget was, so that you can compare and know whether you were making the right assumptions or not. Whereas I think what we've seen some companies do is they'll update it on a regular basis and then just forget what they initially projected.
Yeah, I think that's a good call. One point I want to highlight is that your model is the thesis essentially for for one version of the future that you expect to play out. 100% of models are wrong. Every model that we look at, that we receive from founders, we take with a heavy grain of salt. Are you able to take in new information on a monthly basis and apply that into your model and then update your view of the future based on as more facts emerge on the field? Taking that iterative process to always be updating your assumptions, it is an important part of any model.
With that, before we move on, do you guys want to just quickly introduce yourself?
Yeah, so I'm a senior associate on the deal team, primarily supporting the directors on the team with deal execution. Prior to coming to ECMC, I spent about 12 years in the Bay Area, working for different companies, some large, some small, and then most recently for a large institutional asset manager that looked at deals primarily in SaaS, internet, but more later stage, so Series C and later.
I've been with the team for a year and a half now. I'm one of the associates on the team. Before the CMC, my experience in late stage investing, early stage investing, as well as I started my career actually at PwC, providing financial services. So yeah, I'm very happy and excited to share what we've seen from talking to hundreds of companies throughout the past couple of years, as well as share the tips that hopefully can be helpful to you guys.
Awesome. Is it time to dive into the model now?
Yeah, let's do it. Before we actually dive into the Excel here, I just wanted to highlight every model should answer some basic questions. We just spent time covering the meta, the why, what of financial modeling. From a more tactical standpoint, every model should answer how you get users, customers into your funnel. How rapidly do you convert them? How do you monitor? What's your pricing model? What are the costs associated with keeping all of this running as your inputs? And then your outputs are cash flow. Based on that, how much do you need to raise? We'll use this to sequence our conversation as we're walking through the model. Before we jump into the model, we'll start with everyone's favorite topic, which is generating revenue. And there's a few different approaches that you can take. The easiest one is using annual or monthly growth assumptions. We advise staying away from this method. It's the easiest. If you're looking for a back of napkin approach, it works, but it will be more beneficial in the long run if you select a more bottoms up approach that actually forces you to think about what are the key activities that you need to execute on in order to generate 1 unit of revenue. And so a lot of this is going to depend on your business model, the one that we'll be focusing on, the second approach. We see a lot of founders using the first approach. We recommend using the second or third approach. And then the last approach that we've seen is using more of a tops-down projections and how this works is you start with the overarching market size and assume a market capture rate based on that. So if it's $100 million market, the first year you capture 1% of that's $1 million. Second year you capture 2% of that's $2 million. Again, this methodology helpful. I think it's a helpful check. It doesn't really force you to think about the key activities. We'd recommend against it. So with that, do we want to jump into, Yep.
Thank you, Eric. Now, Eric, walk us through high-level revenue projections. We thought it may be helpful to walk you through a fictional model company to illustrate what that really means. For example, here we have Bright Minds Tech fictional company. They're B2B SaaS. Here we're using approach to that Eric mentioned earlier, which is the direct sales model. So sales as a direct function of salespeople, and also that would typically evolve on a ramp-up period where you need hire new sales staff as well. So I'm going to spend some time just walk through each subsection to help you better understand. So the first one here, so those are customer acquisitions. So it's really looking at realistically how many new customers you can acquire on a monthly basis. We will also share this model after the call. The blue ones are where the assumptions are, and everything else is formula driven. If you change the assumptions, all those numbers that are not highlighted in blue will also be updated. Here you can see the new leads and lead conversions, especially for early stage companies. If you have historical data, you can use that as a base, but if you don't have sufficient historical data, what we would suggest is one, look for some public benchmark to understand what is a realistic number for the market. But number two, especially if you're very early on in your start journey, we find it most helpful to talk to other founders who are at your similar stage or understand the market you're in a similar stage, or what's a reasonable goal for the stage of the company. In the next section here, this is the total customer and churn section. So this is to model out how many customers you will have each month based on number of the new customers you generate, as well as the estimated churn. So here you can see the new customer here. This just feed from the previous section, customer acquisition here. And the outer section here is churn. So similarly, if you're at early stage, you don't have enough existing customer going through the renewal cycle yet, you may not have a good indicator what the churn rate may be. So again, leverage benchmark and talk to other founders to understand what a reasonable goal would be. Here you can put in your ACV, average contract value, assume 10,000 annual contract divided by 12. Each month is roughly 833. Here you have your MRR and ARR. In total, you have your total revenue. So when you're at this step, you map out the total revenue on a monthly basis. We suggest founder take a holistic view at this point to see if everything makes sense. So the total revenue, for example, does it align with the growth story you're visioning, and does it look realistic? Take a look at the key drivers or the components that's driving this total revenue to identify whether there is some assumptions in modification. For example, let's look at the assumptions here. One of those is the implied target leads per rep to hit target. Is this realistic? If it's not, maybe you need to increase a sales team. And also lead conversion, as well as churn rate or retention rate. If your historical conversion rate and retention rate has been lower than benchmark, perhaps there's an opportunity to improve those as well, which can drive your total revenue. Depending on your conversations with your current customers or the product roadmap, there could be opportunity to increase your ACV gatherer as well. And oftentimes, some of those metrics like retention as well as conversion rate would improve or maintain over time. One thing I want to quickly point out, because we got those questions from founders a lot, is what's the difference between accrual-based revenue versus cash-based revenue, and which method should they use? Simply put, accrual revenue is you record revenue when it's earned, and cash revenue is you record revenue when you receive the cash. This really matters and will impact your financial statements when you receive payments upfront, whether it's 3 months, 6 months, or 12 months. In this case, for example, it's an annual contract. If the ACV is 12K, you receive 12K upfront. The cash basis will have you record all 12K during that month, versus the accrual accounting, which is the GAAP accounting that you guys probably have heard of, will spread out this 12K over 12 months and report 1K each month. So basically, when it's earned, and that's also how this model is done. So I would say, in generally, the best practice, the status quo, is to use accrual revenue for a couple of reasons. One is if you use cash basis and you receive upfront payment, it's actually a lot harder to tell the actual company growth story. Makes it difficult to do some KPI analysis against the benchmark you can find, because a lot of those benchmark is done using accrual accounting or GAAP accounting basis. And also, since as your company scale, the status quo is really to use accrual accounting. So we've come across company that if you start with cash basis revenue, when they're big enough, it could be difficult and time consuming for them to restate the historical financial from cash basis to accrual accountings. So I know this is a lot of information. Just want to do a quickly key recap here. The focus really focusing on what's the key drivers of your business. What are the activities and channels that bring in customer traffic? What are some reasonable conversion assumptions? And what are some appropriate revenue models? So in my example earlier, number of leads, conversion of the leads is really what's driving in the revenue projection in that example. And as your pool of customer continue to grow, how good are you at retaining those customers? So as long as you focus on those key things to consider, I think that's a good recipe for success. And happy to answer any questions you guys may have on revenue projection before we move on to the next section, talking about expenses and other unit economics and KPIs.
And I just want to highlight what I like about that model that you put together is that it's hypothesis driven. In this model, she expects to get to 18 customers by the end of 2025. To do that, her hypothesis is that she needs to speak with 500 customers and convert 4% of them. If she accomplishes those two things, it's actionable and hypothesis driven. Those are two of the key things we're looking for with any financial model. If she gets through the first 6 months of the year and that conversion rate is closer to 1%, that's new information that should be used to reflect in your model. And then based on that, if you still are looking to get to 20 customers, the number of initial customer conversations has to go way up to account for that drop in conversion rates. This is what we're referring to as constantly iterative, actionable, and use it as a way to describe the roadmap that you need to achieve your goals. Well, hopefully that's helpful. All right. Should we keep moving? Yeah. So the second part of any good financial model is your cost structure, which I think from a definition standpoint, you have variable versus fixed costs. Basically, variable costs are things that increase along with every unit of revenue. So good examples of that is like any COGS, web hosting, customer support. As you continue to add customers, that increases linearly with the revenue. Those are variable expenses. Then you have fixed expenses, which are more headcount related. So they don't necessarily have a one-to-one relationship with revenue as it increases. What's probably more important when you're just starting out is to differentiate between payroll expenses versus non-payroll expenses. and to really focus on the payroll expenses, because those are going to be like 80 to 90% of your total costs starting out. So really sitting down and thinking about what are the key gaps on my team? What are the key capabilities that I'm missing today? What are the market salaries that are paid for those individuals? And what is my hiring plan to achieve my goals? So that would be our recommendation on where to focus. And then more of a comical take on expenses, but as any company who has investors will well know, investors love to focus on expenses. Revenue, you can have a hypothesis on, but is somewhat market driven. Expenses is something that you absolutely have control over. So understanding your expense base and understanding your levers, how you can move it up and down depending on business needs, becomes increasingly important, especially today.
Thanks, Eric. So let's go through the model, those expenses layers. So cost of goods sold here. So yeah, understand it will be unique, a little bit different for each business, but generally cost is the direct cost associated with the stuff you sell. The other category is indirect costs like salary and rent, which should not be included in cost. Some example include raw material manufacturing overhead, but in general, also direct labors for both SaaS and non-SaaS. So those are the wages paid to people who are directly involved in the production, the product delivery process. And also some other examples like payment processing fee and certain tech fees, such as like cloud AI costs directly related to production and product delivery. I think the key here is, are those expenses directly related to the production or the delivery of the product? If it is, then it should be considered a part of the costs. And here you get the total costs and you can calculate the total profit and gross profit margin. Heading over to the payroll headcount, this likely for early stage is one of the biggest, if not the biggest expenses. So here, this template, anything blue highlighted, those are assumptions you can modify, and everything else is formula driven and will be automatically updated. This is the part where Eric earlier mentioned build your hiring plan, who, how much, and when. It's always best to build based on historical and what makes sense with the company growth story. Over the years, we found it helpful for companies to break those headcount and hiring plan into a couple of key categories, including sales and marketing, research development, or engineering, and for example, customer success. There's a couple of reasons for it. One of them is it's really easy to do benchmark KPI analysis to compare the company plan towards the benchmark. It's really helpful for both your team as well as investors. And the other one is the non-payroll expenses. This one's straightforward. You start with what expenses you currently have. And there are many different approach depending on your company, depending on expenses. But generally what we see, whether it's year-over-year increase, it could be a fixed amount per headcount. For example, travel, maybe has sales marketing per person, your budget is certain amounts of tied to the headcount of those staff, percentage of revenue, or sometimes it could be one-off. So after you have those revenue and expense tab, to give you and your team and your investor a really helpful glance at what your projection will look like, we would highly recommend and have found it really useful for founders to create a separate summary tab. So previously, the other three tabs are more like input tabs. So those are the assumptions that drives the model, things like what drives your customer acquisition, what your churn rates are, how much are you paying your staff. And the output here basically are a set of projections that show if all those assumptions are true, how the company will perform. And you can always tweak and change those assumptions, and the same model can produce multiple sets of projection given those different assumptions. So a couple of things I want to highlight: net operating income. This is revenue minus operating expenses, also called net income. Here is your cash position, especially if you are at an early stage. Cash is very important. It's not more than net operating income. So know that here, as your company scale at a later stage, general investor would expect, and it could be helpful for your team internally as well, to have a separate tab to project out the cash flow. But here, for today's session purpose, I have simplified this, assuming that you received the revenue the same month it occurred, and you pay the expense the same month it occurs. That's why whatever the net operating income would be will be directly changing the cash balance of that month. So keep in mind, if you do receive a large revenue payment upfront or paying them large expenses upfront and you're not creating a separate cash flow statement yet, make sure those are reflected in your cash position so it can reflect an accurate cash balance as well. So there's an important line here as well when I highlight is how much money you will need to raise. So the goal here is to understand, based on all those current assumptions we've made now in revenue, in headcount, in non-payroll expenses, when will the company run out of cash? So ideally, from what we've seen is that great companies will start considering alternative funding options when they use up half of what they use last week, and really start actively working on those alternative funding solutions at least 4 to 6 months before running out of cash. I can show you a couple examples, just real-time change the model to see what it's like. So if we don't raise any money, let's say in April 2025, you'll see the company, according to this projection, will run out of cash in June 2025. And so after we put the 800K here, and you can see the company will have enough cash, roughly the buffer at around 115, which is roughly about 3 months of their cash burn before they receive another round of fundraising. So ideally, they will probably start this process 3 months earlier before they expect to receive it, at least. So this is one of the very helpful feature just to help you understand how much to raise, when to raise. And I can also quickly make the change in assumption. Let's say your ACV, you started out, it's not 10K yet. You realize it's actually much lower. Let's change that to half. So we have 5,000 ACV for the first year. And then a small increase in the second year, roughly 6,000 a year. So here you can see, if you raise 800K, you will actually run out of cash before you decided to raise the next round. So in this case, with the updated ACV, you can play with the number here. If I do raise 1 million, I do have enough before the next raise. And ideally, we understand fundraising can take a lot of time away from founders, and we will and it will be great between the two fundraising round have at least 12 to 16 months gap, so founders can finish the fundraising, get back to building the business and the product. Yeah, let me pause here before we move on to the next section where we talk about economics and KPI to see if anyone has any questions.
Thanks, Chuxin. I think Anthony has a question. Anthony, if you'd like to come off mute, Mindy can help us unmute you.
Hey, team. Warrior.
Hey, good, Anthony. Thank you so much for jumping in. Do you want to just restate your question, please?
My question initially was whether or not the model is going to be shared. And I see that this is really, if you could scroll to the left just for a second here, is this assuming, say, one customer type, for example? Yeah, this is a great model. My business is slightly more complicated. There's 4 different types of customers that would be revenue streams. Each one kind of requires and takes probably a little bit longer than the next. And my revenue model is a bit of SaaS combined with one-time payments, one-time fees. So it's hard to really predict. The way that we do it is more along the lines of a percentage of certain customers that would buy one-time fees versus how many are interested in subscribing on an annual basis. Then there are annual platform fees plus success-based revenue opportunities within the subscription itself, right? So the subscription gets you access to the platform plus a success fee based on usage. We usually ballpark these things based off of percentages. The frequency is almost impossible to predict. So we tried to standardize it to make it at least somewhat directionally indicative without it being 100% accurate, more along the lines of a direction in which the company can grow. Curious to how you think about those things when trying to model things out. From a SaaS-based business, it seems pretty easy, especially the way you described earlier by saying, okay, we quantify what we've just generated in revenue this month and we spread it out over 12 months. Makes a lot of sense, but curious how you would approach this with more complicated revenue streams and frequencies.
I think the problem you're describing is something that a lot of startups experience, is that no business model perfectly fits into the box we're outlining here. The key is to differentiate between each of those customer profiles, Anthony.
Each one is like it's another row or another revenue stream based in the monthly forecasts.
Because it sounds like each one has different activities and drivers.
Correct.
So I think the important thing is just making sure that you call all of those different drivers out, label them clearly, so you can start to track them.
We do. My financial model is robust. It's maybe 12 tabs long. Payroll, revenue, income statement, summary tabs, best case scenarios, graphs. It's very detailed. We spent a lot of time on it. It's just very hard to explain how those different drivers or what is going to be the drivers for those businesses and how those things are going to be captured on a monthly basis because it's so variable.
Yeah. And that's the challenge with financial modeling. I think sometimes we get science envy with financial, like we want everything to be perfect and perfectly predictive. And the reality is that the reality is much, much fuzzier than any of us would like. You're taking the right approach. Good to hear you're scenarioizing, because that's what a financial model is good at the end of the day, is painting a spectrum of possibilities depending on your key drivers. But the fact that you have your key drivers called out and have a good handle on those, I think is going to benefit you in those investor conversations. Do you mind me asking what stage of company you guys are at?
We're post MVP. We're getting ready to launch our solution in the next 6 weeks, bifurcating our customer targets as we release new elements to our platform. I'm actually in the process of raising capital right now, simply to fuel customer acquisition.
Yeah. I'm getting the nudge that we're getting up on time, but would be happy to connect post-call with you, Anthony, and talk a bit more in depth.
That'd be amazing. If you wouldn't mind dropping your emails, that'd be amazing.
The emails are in the Notion page, Anthony. If you want to just click through Eric and Chuxin's email right at the bottom of that page.
Looks like we got another question from Mark on CAC. Always love to hear founders paying close attention to CAC. So the question is, how would you model, would you include paid media in other non-payroll kind of customer strategies within CAC? And the answer is absolutely yes. Any kind of advertising, marketing, anything that is going towards generating leads or goes into your customer acquisition process should be included in CAC.
Here, just real quick example. In the summary page, we have an LTV over CAC here. Once we get the model, if you expand it here, you can see the CAC will include the payroll from sales, marketing, customer success managers, especially if their role is to directly work closely to deliver, to also upsell those product, cross-sell. And management, here CEO, we assume early stage, most CEOs are very hands-on, so a lot of the time will be allocated to sales. Here is the expense and non-payroll. For simplification, we included, for example, travel and advertising into those campaigns. Does that help answer your question?
So just moving on to additional slides, unit economics and KPIs, the conversation every investor loves to drill deep on. I think the most important thing here is, so for a unit economic, it is basically, if you look at the smallest unit of revenue, whether it's a single subscriber or customer, what are the economics associated with that smallest unit? That is typically the definition of it. And I think the most important thing here is, as Anthony was noting, there's many different business models out there. So knowing the economic that's relevant to your business and then starting to track that. Basically, investors want to know, as you continue to scale as a business, is each additional unit that you add going to be profitable to your bottom line, or is it going to continue to lose you more money? Because if it's going to lose you more money, that may not be a scalable business yet. Unit economics change over time. That's the one caveat. So for Chuxin's model, the unit economic that we would highlight and she had already beat me too, is LTV to CAC.
Here, it really depends on your business. There's some of the key KPI metrics you can quickly check on your assumptions to see whether those make sense based on what that means for those key metrics, how it compares to the benchmark. Oftentimes, you should see those metrics as trending towards the benchmark as you scale. During our due diligence and working with different companies, we have compiled a list of very helpful benchmark, vary by different stage of the company, where you're below 1 million ARR, 1 to 10, 10 to 25, 25 above, or even bigger. Those benchmarks surrounding ARR growth, retention, what those benchmarks are like, go-to-market execution, performance, expense, profitability, financing and valuation multiple. And we have compiled those resources and happy to share those with other founders and everyone on this call as well, because we understand sometimes it could be hard for you all. You're so busy building product, doing 10,000 things at the same time. So happy to provide this, and it's helpful.
And in the Notion doc that Mindy linked to at the beginning of our conversation, we actually have links to several benchmark reports. Looks like Chuxin's pulling it up. All of you should receive a link to this page. It has a link to the financial model that Chuxin's walking through, and there's some benchmark reports that are a helpful place to get started. Just to bring things home, your model should make sense, be actionable, be hypothesis driven, and tell a great story. And as you think about pitching to investors, don't lose sight of the story. And that story starts with, what is the market you're going after? Can you go after it profitably with positive unit economics? And I think if you do that and you really know your numbers, then those investor conversations will typically go pretty well. So what is your model all about? It's about telling your story, building your road, calling out the must believes, and then getting feedback. We wanted to leave you with a few best practices, hypothesis driven, go bottoms up to the extent possible, keep it simple, focus on the first 24 months, and continue to iterate as you get more facts. And then don't lose sight of cash. Thanks everybody for joining us.
Thank you so much, Eric and Chuxin, for doing this. This was great. I think that just to reiterate that the Notion page is meant to be a take-home resource for everyone. We've got the model linked in it. We've got a bunch of other links to resources that you can read through and learn more about the practice of financial modeling. And then, of course, we've got contact details for both Eric and Chuxin. So if you've got any questions, just send us an email and we follow up. I just want to say thank you to the two of you for spending the time to build the model. I'm sure that folks have found this super helpful, and I've learned a bunch of stuff as well. Looking forward to the next one. We've got 3 more sessions coming up. One on the 7th of November, the 21st of November, and the 5th of December. 3 different topics. One about when you're looking to exit, the second about go-to-market tools, and third one, metrics that matter. If you've got any thoughts on either of those sessions, just use our registration link to sign up, and we'll see you in a couple of weeks.
Thanks, everyone.
All right.